You're listening to Let's Get Surety. Let me hear your bonding talk with Kat Shamapande.
Hey everyone, it's Kat Shamapande, and this is Let's Get Surety. Thanks so much for joining us for this episode. I have with me today my co-host, Mark McCallum, CEO of NASBP. Hey, Mark.
Hi, Kat.
Great to have you.
Looking forward to today's show. Yeah, we're going to learn about the insurance market.
We are. So we're going to be talking a little bit about how we can help our clients to manage risks in this rapidly changing insurance market. And to kind of discuss that with us today, we have with us David Dolnick. He's the founder, CEO, and principal consultant at Dolnick Rick Advisors. Hey, David, thanks for joining us.
Well, thank you so much. A pleasure to be here.
Can you tell us, before we dive into the topic, a little bit more about yourself and about Dolnick Rick Advisors?
Sure, I'd be happy to. I spent about 30 years working as a risk manager for the construction industry. Employed at a couple of large contractors. And then, but prior to that, about 10 years working in commercial insurance. A year or two before that, also in personal lines. But in the construction industry, of course, I was pretty immersed in working with our CFO on bonding issues. And that's my interest in bonding, which is often a pretty heavy requirement in the construction industry.
Great. So to help us kind of get a grasp of this topic as we dive in, could you give us a little bit of an overview of the commercial insurance market, where it is now, and then maybe we can talk about where it looks like it's heading?
Well, if I had an accurate picture of where it was heading, I'd probably write a book and make a whole lot of money off of this.
You wouldn't be giving it away for free on this podcast, David?
Yeah, fair to say. I think fundamentally, the best way to describe it right now is confused, scared, and expensive. The commercial insurance market has never seen anything like where we're at. We are in many ways in a perfect storm with a lot of stuff happening that nobody can control at the moment. Principally, rates have been rising since late 2019. Increases were fairly modest at the end of the year, but they've accelerated dramatically in 2020. We're seeing in the last quarter, for example, commercial increases from some carriers of 16 to 20% on their commercial insurance rates. You're looking at a number of forces that are driving that. We're coming out of the longest soft market in the industry's history. We've never had soft pricing for as long as we had up until 2019. That alone makes things a little confusing. The need for rate discipline among insurance carriers is very intense at the moment. Earnings are down. The stock market has been confused, fluctuating, anemic. Bond pricing has been suppressed. Earnings on investment tranches have been lower than carriers would like to see. So the pressure has really been pretty severe for them to develop and cling to a rate discipline, especially in some of the more volatile lines or historically underpriced lines like auto insurance, general liability, and a few others. Why is this relevant to bond producers? Well, insurance companies often have two sides of the house, the commercial side and the bonding side. And so it's the same financial reports or results at the end of the year.
So, David, in terms of the various lines comprising P&C, I mean, is the tightening market true for all lines, or that some are at different places? How would you characterize certain lines like D&O or cyber risk, areas like that?
Okay. It's a very good question. The pricing fluctuations up until very recently have been highly uneven. Workers' compensation, for example, has remained relatively profitable for most carriers across the country. There are some isolated hotspots, but the broad range of workers' comp has been pretty good. reforms in California, New York, Illinois, and several other states have softened that market quite a bit. Lately, however, we've been seeing some price increases and pricing pressure in the comp arena. The fear of COVID is driving that. D&O, on the other hand, in particular, was a real hotbed at the end of 2019 and is continuing to accelerate. Shareholder lawsuits are largely what's driving that. Employment lawsuits are driving that. And the uncertainties surrounding COVID-19 lawsuits and litigation, some of which is likely to be brought in the D&O area, are quite likely to scare carriers to death. They're really not happy facing those risks. And that pricing is going through the roof right now. Auto liability, which has historically been underpriced for many, many years, is seeing tremendous increases. It's often been a loss leader for commercial carriers. They'll sell the auto at a fairly inexpensive rate to also get the GL and the umbrella. We're also seeing tremendous price acceleration in the umbrella and excess markets right now. We saw some at the end of 2019, but the acceleration in pricing increases is becoming quite pronounced in that arena. It's still an uneven picture, though.
Right. You had mentioned COVID impacts already kind of having a profound effect on the insurance marketplace. In the news, we've recently seen a lot of hue and cry for political action on business interruption insurance. How do you see that play out, and what further impacts do you think we'll see as a result?
Well, first off, I think the business interruption picture is pretty uneven. There's going to be a lot of pressure on the litigation side of businesses trying to shoehorn claims under their business interruption policies where they may have not had coverage clearly either excluded or included as it relates to the COVID-19 shutdowns. That's going to play out in the courts over the next several years. None of those questions are going to be easy to answer, and the courts are going to be clogged with a whole lot of litigation on that front. The early salvos from a number of large concerns bringing COVID-19 claims against their carriers for BI coverage have largely been determined in the carrier's favor. Most of the virus or pandemic exclusions are fairly clearly worded. There's not a lot of confusion there or a lot of ambiguity. Where this becomes problematic is if some of the more progressive or liberal states, California comes to mind, New York comes to mind, push through legislation requiring coverage where none was intended. The carriers are going to be in some significant financial distress over that. The insurance industry has a pretty powerful lobby that's trying to make that case in those legislatures and to provide a government backstop. There is some discussion in Washington of a federal pandemic backstop to try and ease that political pressure that's being brought. But that's a very uncertain picture at this moment. We still have to pay for the bailout bills, the CARES Act, the HEROES Act, and so forth. How are they going to pay for a federal backstop for pandemic relief? Completely unknown at this point. We do have some precedent with the Terrorism Reinsurance Act.
Right.
That's speculative as to whether that's going to be a model that Congress has the will to follow.
So with the current marketplace, do you see this being an impetus towards captives, at least for certain kinds of risks?
Yeah, actually, I think we do see some renewed interest in captives. That's always been on the back burner. Many large concerns, most major companies and corporations in America have some form of captive for some lines of insurance. The main advantage, of course, is that tends to remove you from the retail pricing fluctuations in the insurance market. you're still buying reinsurance, you're still purchasing excess of loss treaties for the captive, but the retail fluctuations, which are what most companies are putting up with, are largely blunted. So yeah, you're seeing a lot of renewed interest in captives. Vermont is forming captives at a rate that rivals the best years that they've ever seen. Offshore captives are also forming fairly regularly. The IRS has recently decided to back off slightly, perhaps, if they feel like it, on their pressure on micro captives, the 831B captives, which are a little more available to smaller business concerns. But how that's going to play out is yet to be determined. But small micro captives, protected cell captives, and shared captives, pooled captive arrangements seem to be accelerating in seeking new members. New member applications at several that I've been in touch with are backlogged now several months. So
Right.
yeah, whole lot of interest.
Well, it sounds like with all this going on, all the different influences and uncertainties, getting to know a really good insurance advisor is pretty paramount. And then also probably as somebody searching for insurance coverages, figuring out how to put your best foot forward is also paramount. David, why don't you tell us a little bit more about how important that is?
Well, I think that's actually the key. Mark, you've hit on that pretty directly. This is a relationship business. It's pretty much always been a relationship business. Insurance is, at its simple essence, as is surety, a financial transaction. Those are built on trust. Those are built on knowing your other parties, your counterparties in those agreements. You can't know those other parties without forming a relationship with them. Companies that have commoditized their insurance, that change brokers every year, every couple of years, that jump around from carrier to carrier, will suffer tremendously under this hard market. At the moment, it appears that the recession that we're in, the hard market that we're in, are likely to last for at least another 12 to 18 months, perhaps longer, who knows. But in that period, the relationship you have formed with your broker and the relationship your broker has formed with the carriers is going to be a critical element in helping you control those costs. If an underwriter is sitting at a desk and he's got 50 applications to look at in 2 days to do it, it just makes sense that he's going to turn to the ones where he knows the broker, where he understands what the quality of that submission is and has some trust with that brokerage house. If he knows the individual company and trusts them, if they're a previous client that's expanding coverage with that carrier, they're quite likely to get far better consideration far earlier in the process than a new guy in the door that's jumped around and hopscotched 7 carriers in the last 10 years.
Right. It seems like you certainly don't want to give off the idea that your behavior is just focused on pricing. I imagine that you're looking for more of a relationship, as you said, and that you're taking a long-term view. What are some of the other tips that you would have for brokers and their clients and how best to present themselves? For example, is it important if they have standardized processes, forms, procedures? Is that the kind of information you should kind of highlight to the carrier?
Absolutely. I think the critical element here is to stop looking at insurance as a linear function. Normally, we draw a line between the client to the broker to the carrier. And there's never a connection then between the carrier and the client outside of the claims and the risk engineering, risk control functions. I think it's really important for brokers, for insureds to come together and form more of a triangular relationship on the underwriting side as well. Draw that connection between the insured and the underwriters. You can do that pretty easily by getting in front of the underwriters as an insured, meeting with them, forming some trust, bringing the underwriters out to see the operations firsthand. There are some brokers who will resist that. I think that they should rethink their resistance to it. They're a little scared that they lose control of the client. I think if they handle that relationship and encourage that relationship properly, they can actually enhance their control. But what that leads to really is working collaboratively to find the best tools and techniques to cover the insured's risks and do so in the most cost-effective manner possible. The idea here is that if a carrier offers a variety of pricing options, including deductibles or self-insured retentions, both the insured and the broker need to be considering those in light of what's happening in the real world. The other thing that I think is very critical on this is that everybody in this relationship needs to adopt a long-term view. The only way we're going to get through this safely, sanely, and with any kind of financial sense is to look at it as, where do you want to be 2 years, 3 years, 5 years down the road? Especially on the surety side, I think we know pretty well that most businesses don't fail at the bottom of a recession, especially in the construction industry. They tend to get into trouble as we're pulling out of the recessionary slump. Right. And they have rising payrolls, but diminished resources to meet them. The same thing holds true on the insurance side. As your work increases, your premiums will increase. And if you don't have the cash flow to meet those, you could be in some serious trouble. It's really important for all of us to plan for those kinds of things, take a long-term view. I think the critical element here is, if you have SOPs, if you have standard operating procedures, and you can share those with the carrier, that gives them a comfort level. They really can develop an idea of who you are as an insured and how they need to approach you to deal with the risks and the financial arrangements that you're putting in place. If they don't know that, then it's more of a guessing game for them. And carriers are going to guess on the safe side for their own needs and their own financial perspective. So SOPs and standard practices help remove that element of chance, that element of guessing out of the equation.
What happens, let's say, if you don't have a perfect image? Let's say there are some claims that the client has dealt with. How do you deal with that, particularly if you're looking at possibly a new carrier? Is that something you sweep under the carpet, or you come out and demonstrate how the company has dealt with that effectively?
Sweeping things under the carpet is almost never a good idea, especially in these kinds of arrangements. There is a temptation to do that. Of course there is. And what you're really talking about is the average company, where there has been some claims activity. I think it's important in those cases to deal with that head on, to demonstrate clearly, yes, there was a problem, but we understand what that problem was, and we've taken steps to deal with it. We have put in place mechanisms, procedures, and changed our operations in response to discovering that problem. That's something that gives most underwriters comfort. They know that if there's a subsequent problem down the road, that you're far more likely to have an effective answer for it. Failing to do that, sweeping something under the carpet, hiding claims, or manipulating loss runs in some manner is fundamentally dishonest. And when that comes to light, you've now impacted the relationship probably beyond repair.
Wow. Well, I know, timing, at least on the surety end, is very important, particularly for the producer to have the time to make the case for the principal and getting that bond. I imagine timing is pretty important on the insurance side as well, particularly with renewals.
Absolutely. What I tell my clients and my friends in this business is start early, work hard, and work all the way through the end. Starting a complex commercial insurance renewal 30 days out is a problem waiting to be created. Normally, I would suggest for an average company, say doing 10, 15, $20 million of volume a year, you need to be looking at starting the renewal process 90 days out, perhaps even a little earlier than that. So the fundamental thing is to make sure that you understand what you're doing and to do it well. And that requires that you do so early enough in the process for questions to be raised, for discussions to be held, and to form those relationships. You can't do that in 3 weeks or 4 weeks.
Right. And I think that ties in well with your point about communication as well among all the parties and looking at the kind of the long term and that it's a relationship. Are there some other tips you'd like to give folks out there about what other things they can do to improve their position in going forward and getting the right coverage at the right price?
Sure. And I think that a lot of this starts with selecting a good broker that understands your business and working with that insurance professional or that surety professional to face clearly and directly any problems that you've had in the past, any shortcomings that you have at the present, and finding ways to improve your response to those. You can't go back and erase sins that you've committed historically, but you can face them honestly, face them directly, assess them appropriately, and put in place things to prevent them from causing problems down the road. That's really the first step of risk management. I would also emphasize strongly, you cannot have a good risk management program without having an effective loss prevention program. Safety is critical in every industry, all the time, and especially with COVID-19. You have people that work for you that are afraid. They're scared. They're uncertain. They don't know how to deal with this. Face those fears honestly. Take the precautions you need. Put them in place and help your employees do a better job. That kind of a mindset conveys itself all the way through your organization, including loss prevention activities on job sites, in workplaces, or on the factory floor. You can't have good risk management without preventing the losses. If you think of it like a big bucket, you have a tap filling that bucket with claims, and you have claims professionals bailing that bucket out with ladles. The more claims you're putting in, the faster the claims professionals have to work. You got to turn the tap off before they can make any headway, or the bucket's going to overflow on you. So managing your risks is really the critical element. Hire a good risk professional to work with you, whether that's your broker, and many of them have risk management functions within their organizations, or if not, look outside or have somebody in your organization that gains the experience and the knowledge to help work with those risks. That burden often falls on the CFO, who's also responsible for the financial results of the company, also responsible for managing the surety relationships. In smaller organizations, that can be a very effective way to do it. In larger companies, that's probably a little bit challenging to have one person dealing with all of that stuff. These days, commercial insurance is going to be a much bigger part of your budget than you thought possible. It's going to be a bigger part of your budget in a declining revenue pattern. The recession is here. It's real. people are doing less work. People have less volume, especially in the hospitality industry, which has just been decimated by the shutdowns.
That's all great information, perhaps a little sobering on some points.
Sorry about that.
That's okay. So if you were going to hazard a prediction in the next 12 to 18 months on the insurance marketplace, you've given us a lot of great characteristics of where it seems to be going now. Do you see that trend continuing, or do you see any further changes in the near future?
Well, as has been observed by someone much smarter than me, predictions are very difficult, especially when they're about the future.
Yes.
So, with the caveat that I could be completely wrong here, and I always approach a prediction with that kind of a viewpoint: is I may be completely wrong, but my best guess at the moment, based on the data I'm seeing, based on the trends that I'm seeing, is that you're going to continue to see double-digit quarter-over-quarter increases in rates on most lines of insurance. Workers' comp will be a little bit slower than that. Claims in a recession tend to fall. During a recession, you have fewer people working, and you thus have fewer opportunities for claims. The big exception to that, obviously, is going to be the healthcare industry,
right?
Where people are working overtime, much more exposed to COVID-19 than any other industry. But in general, comp is going to remain a little less pressured than other lines at the moment. But pretty much, if you looked at quarter over quarter on an annualized basis, you're going to be seeing solid double-digit increases for the next 12 to 18 months. That's sadly my prediction of where we're headed with this.
Certainly food for thought.
Yeah.
I know you were generous in contributing some articles to the Surety Bond Quarterly on helping clients in a rapidly changing insurance market, and we thank you for that. And those are available where you can really get a number of additional tips, as well as some that we talked about today, at the Surety Bond Quarterly website, suretybondquarterly.org. David, really great information. Thank you.
Well, it's
Thanks,
truly
David.
my pleasure.
And if anyone wants to learn more about your company, where should they go?
The website, dolnickrisk.com, probably the best source. All my contact information is there, and I'm happy to answer or address questions that your members may have.
Thanks so much, David.
Thank you.
Very much my pleasure. I'm honored to be here today. Thank you.
You've been listening to Let's Get Surety, brought to you by the National Association of Surety Bond Producers. For more information about the NASBP and its members, visit nasbp.org.